This segment, we're going to be talking about income streams. Now, the way Canadian taxes work, there are four income streams that flow into what is known as your net income for tax purposes. That's the technical term. People also refer to it as taxable income. Now, those streams are the streams through which all of your potential earning activities are categorized by the Canadian government, the CRA being their representative. The CRA is the Canada Revenue Agency. So there are four basic income streams. Number one is employment income. Number two is business income. Number three is property or rental income. And number four is capital gains and losses. Actually, net capital gains. So your employment income is your everyday job. Somebody has given you a letter of employment and told you that you come to this desk, you do these certain activities, and at the end of 2 weeks, half a month, a full month, or daily basis, as the case may be, you will receive compensation for whatever activities that you carry out on their behalf. Now, in addition to that, they would take from that compensation what is considered to be your taxes and remit that to the Canada Revenue Agency on your behalf. At the end of the year, that employer would also issue to you what is known as a T4 slip, which is a summary of your earnings and deductions for the entire calendar year. And that is what will form the basis of you going to prepare and file your tax returns with the CRA. Now, that is how employment income works. Very rarely are you able to deduct expenses against employment income. You are only able to deduct employment expenses when your employer signs what is known as a T2200 form, which authorizes you to expense certain items as at the discretion of your employer. And that is employment income. A second income stream is business income. Now, the CRA defines business as an adventure in the nature of trade. Now, that means you are heading out there trying to take something that you have or that you made or that you do and trade it for money. So as long as that's what you are doing, the CRA recognizes that activity as a business activity. And you are expected to report all business activities. Any income you earn as part of your business activities, the CRA expects you to report it. Now, you're not only expected to report the income, you're also expected to report the associated expenses which you incur to generate those incomes. So with that in mind, we suddenly see that there's a significant difference between when you're dealing with employment income and when you're dealing with business income, because the income and the expenses are reported not at your discretion, but you are in total control as the business owner. Now, that creates an advantage, but the advantage is simply when you have a business, ensure that you report all of the income and all of the expenses. So that's pretty much how business income works. The next stream is what is known as property income. And that comes from when you own an asset and you get paid for allowing other people to use that asset. The asset in this case most commonly is real estate, but other assets that could generate property income include royalties, rights to music, artwork, vintage cars. These are all things that you can get paid because you own them and other people want to use them, either to display them or for whatever purposes. Now, the way this works, it's very similar to your business income, but the difference is that you're not really doing anything to get paid. You are getting paid because you own something. The CRA also recognizes that that process of ownership and generating income through ownership can give rise to expenses. So you are allowed to recognize any associated expenses as it relates to your property income business. So it's very similar to your business income. You would record all of the income you make from renting out your property, and you record all of the expenses that you incur from as a result of renting out those properties. And the net is what flows into your taxable income bucket. That's the third one. The last one is net capital gains. Net capital gains are different from the other income streams. And that's because the way capital gains work, capital gains arise out of the disposition of an asset. So you have a house, you rent it out, after a while, you're like, okay, I want to cash in on my equity, and you sell it. That process of selling is known as a disposal or a disposition, and it is what triggers the capital gain loss calculation. A capital gain simply means that you have sold the property for more than you bought it for, whereas a capital loss means that you have sold it for less than you purchased it. That's how that works. Now, from a tax perspective, the net capital gain is what flows into your taxable income bucket. Net capital gains mean that when we consider all of your disposals for the year, we are able to say that on a whole, the amount you got back from selling your property is more than the amount that you paid to purchase the properties whenever you may have purchased them. When that is a positive, when you have a gain situation, then that gain is taxable and it flows into your taxable income bucket. On the other hand, when your net capital situation is a loss, which means that the total you have gotten back from selling off these properties is less than what you paid for them, that loss does not flow into the taxable income bucket. That loss does not flow into the taxable income bucket. So you cannot use taxable losses to reduce your taxable income. All you can do is that they will be eliminated. However, you are allowed to carry your taxable losses into the future, which means if you have a taxable loss this year, and then next year you have a taxable capital gain, you can use that capital gain to reduce this year's capital loss before the number that flows into the taxable income bucket is determined. So with this very high level conversation, you can see that awareness of where your income comes from can be very beneficial when you are planning your taxes. Now, is there an income stream that is better, that is preferable, that is desirable? The answer is an absolute no. However, it is key that you are aware of the impact of the stream that your income is coming from and how it impacts your taxes so that you can make the right decisions about how you bring the income into your tax returns. So those are the things that we want you to be cognizant of and that we want you to be aware of. And after this, we'll talk a bit more about credits and deductions. But for now, thank you for watching.